Well, good morning, everybody, and welcome to this panel session, which will focus on mobilizing capital to fund Africa's current and future growth. It's a well-documented fact that Africa in general needs billions of dollars on an annual basis to fund, to boost its infrastructure, to promote intra-regional and intercontinental trade, to boost up its education framework, and last but not least, also to fund the investment requirements of its private sector. So the key question is, how do we go about mobilizing those billions of dollars? What kind of structures do we need in place on the ground to facilitate capital raising? What are some of the obstacles that are currently hampering capital inflows into different countries and different regions in Africa? So all these questions will be addressed in the coming few minutes by our distinguished panelists that we have today here. And I would like to introduce them briefly to you. We have first Mr. Ed Matthias, who is Managing Director, Carlyle Group, on my left. And then next to him, we have Keith Nichols, who is the Managing Director, Thomson Reuters Africa. Then we have Sarah Alexander, who's Managing Director of the Abraj Group. Sitting next to her is Uche Oji, who's CEO of Nigerian Sovereign Investment Authority. And then we have Susan Bishop-Rick, Director, Investment Management Division of the U.S. Joint Staff Pension Fund. So we have a very interesting panel here. And without much further ado, I'm going to shoot the first question to Ed Matthias from Carlyle Group. Ed, Carlyle has been the first global alternative asset manager to have a footprint in the African investment space. And you've raised about, I think, $600 million to invest on the continent. Can you share with us what your general experience has been with regard to Africa in terms of capital raising? And then how do we go about enticing the US investor base to look at Africa more closely and to engage with Africa?
Well, thank you very much for having me. The Carlyle Group manages approximately $200 billion worldwide. Each firm has a different model. Ours is to have funds dispersed all over the world, have people on the ground, a local presence, and then try to take advantage of the global platform we have. As you mentioned, we were the first US-based global alternative asset manager in Africa. We raised about $600 million. We have a very long-term commitment to the area. I thought I'd touch on three quick things. One is the capital raise, which proved to be more difficult than we thought. Secondly, very briefly, what our strategy is. And thirdly, what some of the problems we are encountering or issues as a U.S. domiciled investor. That, first off, fundraising, we found the awareness and the interest was extraordinary. And I'm talking now mainly about institutional investors, primarily in the U.S. Having said that, raising the money proved to be quite difficult. A lot of impediments. How do you do due diligence? The idea that you're going to spread your investments across 4 or 5 countries, the fact that you may be early, and then some of the stories. So we ended up raising most of the money from 2 sources. One was sort of African entrepreneurs and institutions who are very much committed and excited about the region. But then secondly, we found really strong demand from what I would call wealthy families, whether it be family offices or individuals. And finally, through a major bank, we raised almost 40% of the fund through what they call a feeder fund. The bank went to their clients, and again, individuals had a very, very strong interest in that. So we're now up and running with $600 million. We feel that long term, there will be tremendous institutional interest. But I think first, they want to see a record of investment, particularly with exits, and get more, have the market grow, and just get a little more comfortable with it. So there's an educational process going on, and I think we're very early in terms of funds being committed. As you may be aware, institutions like Cambridge Associates, some of the other consultants, some of the government institutions are all kind of fostering interest in Africa. So we're very early, but very optimistic that'll continue. What we're trying to do is target investments of $50, $75 million or so, well-run companies, et cetera. Let me just summarize that we see no shortage of interest in those deals. They're basically few and far between, and when one comes available, there is a lot of attention. Finally, as a global firm, Washington, D.C., or U.S.-based, we have a lot of challenges that we have to deal with and complexities. And I won't go through them all. I'll just highlight them with the idea that you probably know. Financings are very different than elsewhere. The legal structures are very complex. We have to deal with tax jurisdictions going across a variety of companies. Logistics, again, when you try to deal with companies that are serving a huge continent. And in addition, two factors that are a little more kind of pronounced in Africa, one being currency among the countries and the volatility. We've seen that certainly in South Africa, and I think elsewhere it's on the horizon. And then finally, so the whole idea of corruption and whether the perception is worse than reality, I think is a real question to ask, but it is something on everyone's mind. We as a U.S. investor, even though we have our funds domiciled elsewhere, are subject to things like the Foreign Corrupt Practices Act, which can cause you a lot of problems. And how you deal with that is a very, very complicated issue. We have found that the best way for us is to really have good relationships on the ground and be able to check out the people we deal with. That is just of paramount importance. Lastly, I'd say, and others will probably address this, the infrastructure to do deals and provide the kind of services and financings that you need is embryonic. It's at a very early stage, and it can be very, very costly. So having said that, we're very opportunistic. We think that there are a number of deals. We're going to run a concentrated portfolio, and that we're confident that this is a really strong long-term opportunity, both for our firm and for Africa.
Tell me, Ed, in terms of time frame, when an institution like yours has raised $600 million for investments in Africa, what's the time frame in general, on average, if we can ask that kind of question, for really investing the money in terms of deal flows and others? How long does it take, and how does that compare with other regions where you might have been involved in Asia or Latin America?
One difference is that we believe that there are a few really good deals, so we will not run a highly diversified portfolio. But our target would be to put the money to work over, say, a 3-year period. And in our business, to raise more money, you have to return money. So our idea would be to invest over 3 years and return over 5 to 6 years. And people's expectations are, in Africa, you should earn a higher rate of return, albeit there's inherent risks. And one of the attractions, of course, is that the world in general is slowing down, and Africa is, I think, going to have 7 of the 10 fastest growing countries over the next 10 years. So growth is a great appeal. I would give one caveat, though. There's been a lot of academic work that suggests there's no correlation between economic growth and investment returns. The real arbiter of how you make money is what kind of price you pay, and then can the company grow.
Okay. So I will now turn on to Sarah. Sarah, you're the managing director of the Abraj Group, and as a global growth private equity institution, Abraj has been in Africa for the past 2 decades, which is relatively long. And you were telling me that you already hold about 50 investments in sub-Saharan Africa, or in Africa in general. And more importantly, your firm is employing about 22 professionals on the ground in sub-Saharan Africa to look for opportunities and to look after your investments in Africa. So can you please share with us in a few minutes what you've learned from your experience on the ground, And where do you think the opportunities lie in Africa today?
Sure. Thank you very much for inviting me to be here on behalf of the Abraj Group. To give you a little bit of context, which informs our views on the opportunities today and our strategy, of course. Members of our team have been on the ground investing in private equity in sub-Saharan Africa for 2 decades. Part of our team was with the CDC Group, which was the British government investment development agency, and they spun out about a decade ago. And so Abraj, as an independent private equity firm, has been investing over a decade. So we've got 2 funds that we've already invested. We've invested about $500 million across just sub-Saharan Africa, $2 billion if you include North Africa as well. So we're pioneers in the industry, and during this time it's really over the past 2 decades, people on our team have done over 100 exits from private equity deals in sub-Saharan Africa. So, over the last decade, we've made 54 investments across 9 sectors in 12 countries. And I say this not to sort of try to show off but rather because our deep and lengthy experience in these markets has taught us, we think, what works and what doesn't work. And hopefully, informs not only our current outlook, but also has helped to raise interest among others. And we welcome the global alternative asset managers like the Carlyle Group coming in and giving Africa the attention that it needs. But so three lessons that we have learned that very much inform our approach, and they are these, and I'll talk a little bit more about each of them. But 1, be local everywhere. I'll just say, not just be local everywhere across the continent. 2, have global standard resources, a global platform standard resources that apply global best practices locally, and comparative experience, so you can draw from not just tens, but hundreds of other investment experiences you've had in other growth markets which have similar attributes or similar companies to those in the Africa space. And the third is, in sub-Saharan Africa, to focus on mid-market deals. So on the first one, the be local everywhere, I don't need to tell all you this, but obviously it's a region of 48, sub-Saharan Africa alone, 48 countries, 800 million people. It's not just one market. You can't invest from London, nor can you invest just from East Africa into West Africa. And in fact, maybe in West Africa, you need more than one office as well, because there are multiple cultures and ecosystems in West Africa. So we have 4 offices. We have significant offices with Nairobi, Ghana, Lagos, and Johannesburg, and that's how we cover. Plus, we have North Africa, but I'm not discussing North Africa today. The second reason why you need to be local everywhere is so that you're proximate to both the opportunities and the risks. To Ed's point, it is all about sort of pricing and mitigating the risks. And one of those risks, obviously, is who are you doing business with? And the people best placed to know who you're doing business with are people who are locals, very locals on the ground. So we have 22 investment professionals, combined. They speak, there are 8 nationalities, 15 languages, 20 years of experience investing in these markets. And then the third reason why we believe it's critical to be local is just the deep access and connectivity you get within these markets. Africa is still a place where you can source proprietary deals, or you can certainly have an advantage in non-proprietary deals if you are local. we, tend to invest in probably smaller ticket sizes generally than maybe what Ed, you suggested Carlyle might be looking at. We look for a more diversified portfolio and probably a larger number of deals in a given fund. So we don't see actually a lot of competition for the deals that we look for. The second lesson that we've learned is that your returns will be much better if you can have global standards and resources that you can bring to bear on the regional investment, with the regional investment teams and on the regional investments. So just to note three points around this. One is that, a fast-moving consumer goods company in West Africa is going to have some similarities with a fast-moving consumer goods company in other parts of the globe, particularly in an emerging market, a growth market. And so to be able to bring insights around the opportunities and some of the quick wins and things that work as to expand those companies is very helpful when you're evaluating the opportunity and you're looking at strategic buyers or IPOs as you exit. Being regional, local, regional, and global also helps you become the preferred partner with the best firms who want to grow throughout the region. So a lot of the plays here in sub-Saharan Africa are around taking local companies across the continent or more broadly in their region and or helping them expand to other growth economies across the globe. And the third area is that, to Ed's point, that just because an economy is growing doesn't mean you're going to get returns out of the economy. That we invest in growth deals, but we invest alongside management and work with them to drive the growth agenda. And that's really absolutely critical. So it's not just the price you get in, it's what kind of growth are you going to get. And the kind of growth you're going to get is by backing solid management, but also bringing in people who have deep operational experience. We have a team we call the Abraj Performance Acceleration Group that comes out of industry, that works with us as part of the investment team, that works with the entrepreneurs to help them drive and grow the business. The final thing, and then I'll end, is the sweet spot of mid-market deals. Mid-market can be many different things. We look generally at kind of $10 to $100 million equity checks. But in our view, based on all the deals that we've seen and the deals that we haven't done and the deals that we've done, it is very helpful to be able to be opportunistic with the financial resources to do larger deals when they come available. So this also then, one of the questions I was asked is, do you give co-invest to LPs? And the answer is yes, because if you can do larger deals, then you can take them on, and then you can provide those co-investment opportunities to the LPs. So just a quick example, I can't speak too much about it because it's not closed yet, but we announced our intention to invest in the largest fast-moving consumer goods company in West Africa. It's a very large deal, but that, being local, one of our local team members actually had been on the board of the company and had seen it for 15 years. They knew us, we knew them. We knew that didn't give us sort of an inside track, it just helped us understand the value of the company, right? Then, because it was a complete exit, we're buying 100% of the company, we were able to work with management to help them figure out how they're going to grow it after the acquisition. And then third, it's a huge co-investment opportunity for our LPs because this is much bigger than we would want to do on average.
Okay, thank you. Just a follow-up question to both you and Ed. When you go about investing in Africa, in terms of strategy, do you follow a sort of general macro analysis of where the opportunities lie, and then go to those companies that offer the brightest investment potential in terms of returns? Or irrespective of the business climate in a country, you would still go and pick and choose, those best companies that may be operating in an environment where the business climate is not that appropriate or friendly. So how do you go about?
I'll just make a quick quack. First off, with 50 countries or so, you have to really concentrate in where the opportunities are. So it quickly gets you down to 5 or 6 countries. The U.S. market is quite mature in terms of this type of activity, and you have a huge degree of specialization on the part of industries. I think when you go to the emerging markets, you're much more industry agnostic. You don't totally ignore political risk and some of the problems, but you really look for well-run companies, management, the same criteria we would look for here, but less of an industry specialization.
I mentioned we've done investments in 12 countries. We'll look at more. There are certain countries that we won't go to for obvious reasons. Even though we're not domiciled in the U.S., we follow every Foreign Corrupt Practices Act. You name it. So we're not going to touch certain companies, and we're not going to touch certain countries. But generally. Our view is that we want to invest in a diversified portfolio of companies across sub-Saharan Africa, so not just 4 countries, but we have our focus countries. And we want to invest in companies where we believe there will be consistent performance and consistent return. So we're not taking venture risk. Right? We're not doing startups. We're not looking for home runs, right? We're looking for consistent returns. And if you find a great company that doesn't happen to sit in, a country where you have an office, if you are very well networked and you really understand it, we'll look at it very seriously.
But just to finish up, we're not in that business, and I don't think Sarah is either. Africa really needs venture and entrepreneurial capital. And that is not going to come initially from the U.S. It's going to have to be local capital, local funds, maybe enhanced from the government. But that's how you will build big companies in the future. And it's not easy, but that's a real requirement in the countries.
Okay, thank you. Susan, you manage a portfolio that is worth, I think, about 49 billion US dollars, and you invest across different asset classes throughout the world. Can I ask you how much of that huge portfolio is currently devoted to the African investment space? And are there any plans to increase that allocation, that asset allocation, given the fact that Africa is today growing at 5% plus and is growingly being looked at as the most attractive investment frontier in the world? So are you looking at increasing your asset allocation to Africa, and what are the criteria that would, other than the growth figures that I've mentioned, that would induce you to really increase your asset allocation to the African space?
Well, that's a long discussion, but we do find the growth very attractive. The buoyant economies always give a headwind to economic growth. But let's start from where I come from. I'm the director of a pension fund, and we have fiduciary duty. So when everybody talks in this meeting about mobilizing capital, we have capital that we want to invest, but subject to our fiduciary rules, which require safety, profitability, convertibility, and liquidity. Those are watchwords given to our fund by the United Nations General Assembly. By the way, I'm the United Nations Joint Staff Pension Fund. So we invest in basically any country, although from day to day, we may have exposure to maybe only 25 or 30% of the countries of the world. And fortunately, we have a very good exposure to Africa. Following our rules of safety, we have always to look at the rule of law, and we love to see domestic savings and investment before we go in large quantity into any given market. And these are criteria that are improving in Africa. We are actually very encouraged to see the new startups of sovereign wealth funds because they show that there's local money in these markets. And I don't know about you, but I want to eat when the chef eats his own cooking. So having the local investors doing well is always very encouraging. Last year, when we had our investments committee meeting in Botswana, we looked to the model of the sovereign wealth fund in Botswana. There is good governance in Africa, and I think it's a growing trend. That's why we want to commit more money. It's not just the growth, because as I think others on this panel have pointed out, growth does not always translate into profitability for investors. And our goal is to earn a profit because, as a pension fund, we have liabilities to pay pension benefits to any employee of the UN where they may retire. So that means I have a liability to pay pension benefits in many countries of the world, including the 48 in Africa. So I want it to be perfectly matched, which of course is never possible, to have investments generating cash flow in each of the markets that can generate a safe and profitable return. As for the business environment, we are seeing tremendous improvements. We would love to see more currency stability, more assurance of the rule of law, avoidance of capital controls, and looking at the liquidity building in the markets. And I think the interest in African growth is going to build on liquidity in every way. Our fund started investing in Africa almost 40 years ago, simply because of our constituency, which of course includes member states from every nation in the world. And that gave us some much better insight going into the less liquid asset classes where we began our investments in 2010. As of the present, our private equity portfolio in Africa looks very different than our private holdings in the rest of the world. And the reason is that we found that in the high growth markets of Africa, the opportunities were actually better in private equity than public equity. And we have seen some exits from some of the early deals that we did that are actually helping to grow the public markets too. But I think that Sarah's point about encouraging venture capital in earlier stage is an important one because it's those entrepreneurs that get the business community growing so that a very conservative investor, such as a pension fund, or probably like our colleagues in the sovereign wealth area, needs somebody to get the ball rolling. And it's those entrepreneurs that are really going to energize Africa. So as far as we're concerned, we see tremendous growth opportunities. We like the private equity markets better than the public equity markets now. We have exposure to fixed income. We have exposure to real estate. We have exposure to public markets. We have a pretty balanced portfolio in Africa. But compared to the developed world, we're much more oriented towards a private equity because of the way the growth translates into returns for our fund.
Just to, an add-on question. You're mentioning that you tend to prefer the private equity space in terms of investment rather than the publicly listed investments route, because you think that the growth opportunities are higher in the private equity space than in the publicly listed space. But when I look at the statistics regarding the performances of African exchanges over a period of 10 years, I mean, the performances have been very, very attractive in US dollar terms, spanning, on average, on many markets, higher than 18 to 20% in US dollar terms. So why are you shunning that space, and why are you rather concentrating on the private equity space, which I think is as important, but for a pension fund that is, looking at investment opportunities where exits are important, being in the private equity space, of course, means that your exits could be five years down the road, whereas being in the publicly listed space means that you can invest, and then if there is growth, you can reap the benefits of that growth. So what's your take on that?
I think the way to look at this is a history of any pension fund, that the assets are built up over time. And quite fortunately, my predecessors in the UN Joint Staff Pension Fund had the wisdom to invest in the public markets of Africa before I came. And as pioneers in those markets, they contributed nicely and continue to contribute to the performance of our fund. So what I'm saying is that today the incremental money is more going into the private sector, and that's partly because we already have such a healthy exposure to public equities in Africa. And I'm very grateful for my predecessors for making those wise investments. We have recently diversified and added additional public equity too. But where the most commitments have been made in the last couple of years has been in the private equity space. And we've found that to be very attractive, and we look to increase our commitment in Africa. Again, we are global. We allocate our assets where we see the potential for returns. And I keep hearing people talking about political risk and corruption, but just listening to the local newspaper here, you realize that political risk is not just in Africa. I mean, there's political risk right here where we are. So let's see where political risk really is. We've looked at infrastructure investments all over the developed world, and some of those stories are not very pretty. And I guess I shouldn't name names because it would be politically incorrect, but look at some of the more public infrastructure deals all over the world, and they do share some risky characteristics. And again, these are not unique to Africa. As a public investor, I'm always asked, why don't you help us build this road or this hospital? And those are wonderful things to do. But again, the local community has to want to pay part of the stake. If the local community does not want to contribute to an investment, how is it that I, as an investor, will get a return or a need to raise prices or a need for additional capital or additional support? If a project isn't popular enough to get some local funding, then I have to be more careful. So again, I look at the development of better entrepreneurial spirits in Africa, and I see that as a great positive. And I look to the future for the building of additional sovereign wealth funds, because it's that local capital that gives me the comfort as an international investor. I want the chef to eat his own cooking.
Okay, so I think this sets the scene for Uche to intervene, because Nigeria has set up a sovereign wealth fund recently of $1 billion US dollars, which I think is expected to grow over time. So I just wanted to know if you could share your thoughts, Uche, with the audience here about what are the objectives of this Nigerian sovereign investment authority that has been created. Where do you see opportunities in terms of investments, and how much of your investments are going to be devoted to the rest of Africa, not only Nigeria?
Sure. Thank you very much. I'm not a chef, but I think I understand the point you're trying to make. All right, real quickly, I'll say two things. I think the first thing is the emergence of sovereign wealth funds in Africa is a very, very welcome development. More for orthogonal reasons, such as the need for transparency in the use of capital in Africa. And I think once you start to make the resource control and distribution transparent, that solves a lot of problems, including political problems, I think. And I say this in the context of Nigeria, where if you had set up the sovereign wealth fund in Nigeria 20 years ago, with very minimal returns, let's say 2-3% returns, you'll be looking at something closer to $60 billion today. But then you look back and ask yourself, where is that money? Where will it have gone? And the reality is that has not been properly accounted for. So the reality here is the fund that we have today, I think, becomes a tool of fiscal discipline for the government, and also begins to create a new pool of capital that I think participates in the domestic economy. And I think it's a very, very welcome development. And I commended everybody who played a role in passing the law that set up the Nigeria Sovereign Investment Authority, because I think it changes a lot of things going forward for the country. Now, in terms of the way this was set up, I think the first thing that the government did right was to have a law that sets up the fund. And I think most other countries should look at doing that instead of making it an administrative arrangement where the parliament sits down and decides this is how we're going to spend money and this is how we're going to invest it. With a law behind it, I think it starts to also have a strong basis to grow. Obviously, the feedback we've had is $1 billion is nothing, it's really not big enough. The reality is it's probably not more than 8 sovereign wealth funds out of about 60 or 70 in the world today have started with more than $1 billion. And of those, I think about 3 of them are in Africa. Nigeria and Angola started with $5 billion. If you look back at Norges Bank, 1996, started with $300 million. Now it's $765 billion. So the key here is not so much about how you start. The key is the disciplined contribution that you make into the fund. And this is where it becomes more interesting, in my opinion. So Nigeria has started. It ushers in an era of fiscal responsibility and transparency, and I think it's a welcome development, but also now provides a pool of capital that can be used domestically. Now, into the setup of the fund, probably 3 things. The first thing is we have 4 funds within the Nigeria Sovereign Investment Authority. The first fund is a stabilization fund, which is really a cash type fund that is available to the government for when they need stabilization support. The second fund is a Future Generations Fund, which is a diversified pool of funds that cuts across everything from developed market equities through to emerging market equities and fixed income, as well as private equity and hedge funds. I must say that fund is heavy on hedge funds just because of the returns target we expect. We're looking at CPI plus 400 basis points as a return benchmark for that fund. So it's fairly aggressive in this environment, which is why there's a lot of skew towards hedge funds and private equity. 20-year investment horizon. So I think that in many ways it's a light time frame that allows us to be careful how we deploy across the allocation that we've published. The final one, and that is split into 2, that is an infrastructure fund, which also has a subset, which is a social infrastructure fund. Again, I think most of these were actually in response to investing in Nigeria, as well as providing to solve today's problems for the current generation, which is infrastructure, and investing in future generation, which is savings. The infrastructure fund, we are managing that in-house. The first 2 funds I mentioned are sourced. The stabilization fund is fully invested already. We've selected managers for that. We have Goldman Sachs, Asset Management, Credit Suisse, and UBS as the managers for that fund. The Future Generations Fund, we are still in the process of manager selection. Hopefully by the end of the first quarter next year, we'll have made substantial progress in allocating those assets. For the infrastructure fund, where we see opportunities and areas where we've decided to narrow, areas where we think that can be good returns and a platform for attracting foreign capital as well into Nigeria, and areas where we think can make a national impact and solve a problem for the country, which is within our mandate. And here we have a pipeline of about 12 things we're looking at, and ranging from toll roads all the way through to agriculture and healthcare, power and aviation, as well as affordable housing as one of the key areas we've decided to narrow down upon at the moment. Our policy statements are on our website. I wouldn't bore you with the details on that, but the point here is a couple of lessons I have learned, and I'll probably keep my remarks brief from here onwards. The first is there's interest to invest in Africa. We've been overwhelmed by how many people are looking at us. And in terms of your comment, Susan, earlier, many people look at us as come and co-invest with us. It doesn't matter if it's just $1 million, just come and share the risk with us. And I think there's a unspoken expectation that it will be a form of political risk insurance. And I think that's not tested yet, but I believe that in many ways that is something that should not be seen as inconsequential as a way of contribution in terms of people wondering, will we be safe? And we say to people, just give us a call at NSIA. If you want to invest in anything, let's have a look at it together. If it fits within our mandate, we'll certainly co-invest. The second lesson is, look, this is a startup company, and we've built a very, what I think is a very good team, but it's also a team that's learning to invest together. And we stepped back to try and have partnerships with firms that we can work with. We announced 3 out of 4 of those partnerships. We have one with General Electric, where we're looking at opportunities in aviation, power, healthcare, as well as rail sector. We announced one with IFC, where we're looking at a whole bunch of things, including affordable housing. And then the third one is with Africa Finance Corporation. And there's a fourth one that at the moment we will announce when we have a transaction on the table. So we have these relationships that I think that are helping us leverage resources that we didn't have as well, and hoping that we can have our first announcement in infrastructure before the year is out. So this has been the progress made. But the third lesson, and I think something I really want to mention here, is the biggest challenge we face is in the quality of the deals that come to us. Deal preparation is still a challenge in Africa. And to address that, one of the things we did was to create a subset of our fund, dedicate that to project development. And believe me, it's really something that I think when you are looking to do some of these transactions, especially where it's a PPP transaction, you need to set aside some money for project development. And I think, in terms of what we found was we actually had to go back and create our own deals. We had structured ourselves such that we just invested, across the capital structure. But we found that we've had to step back into co-development role, as well as even in some cases sponsoring certain transactions by ourselves to try and create deals that we believe are of quality that we can then present to the outside world and say, come and co-invest with us. So that's part of why it's been a little bit slower than normal to deploy capital. But I think the opportunity is there, there's no question about it. I mean, again, to the point about growth not necessarily translating to investment returns. I think if you move up the risk, move down the risk curve a little bit and take a little bit more risk, my sense is that the returns are quite incredible. And this is where we think the big role everybody keeps talking about is the risk people talking about is political risk, is corruption and all that. We see ourselves as a public sector company with private sector philosophy. A whole bunch of people that work for us, US nationals and residents. And so FCP applies as well, and so we're very careful what we do. The bar is not lower because it's a government agency. No, if anything, the bar is actually higher in our opinion because we answer to 170 million people. So this is really where it starts to get really interesting in terms of what we do. So look, we see ourselves as a conduit. We see ourselves as providing the platform for those who want to invest in some of the areas in Nigeria where you are finding it a little bit less the returns are there, but you're careful about how you want to gain there. The NSI is there as a partner of choice that you may want to work with. So I'll probably just keep my comments, stop here, and then if any questions, I'll take.
Okay. Keith, information in general is the lifeline of investments and of portfolio flows, especially when you're dealing with investments in organized markets. We all know about that. Can you please share with us your views about how Reuters is trying to democratize information on listed but also on unlisted opportunities in Africa throughout the continent? And what are your plans to improve information flow? The reason why I'm asking this question is I remember, I think about a few years ago, Mark Mobius, who is a specialist investing in emerging markets, said that he finds a lot of opportunities in Africa, but the reason why he's not increased his asset allocation in the way he would have loved in African listed securities, it's because he doesn't have the quality of information that he's looking for. So what is Reuters doing on that front?
Thanks, Anil. Thanks for having me as well. I think the interesting piece of being an information provider, I come at it from a little bit different perspective than the rest of my panelists. When I look at the impediments of investing in Africa and investing anywhere for that matter, I look specifically at the two major obstacles I see, which is really the access to information, that translates into transparency, and then really just the improving the actual investment climate or the business environment itself. And Thomson Reuters is in a very unique position to improve both transparency and improve the investment climate. And what I like to say, I've been with Thomson Reuters for well over 10 years now, but I've been in Africa for the last 18 months or so. And my mantra there is that Thomson Reuters really needs to help enable the African growth story and not merely just take advantage of it. I mean, we're in a unique position because of our products and services to do just that. I think most people are familiar with our financial information products, and I'll talk a little bit about that and what we do with some of the exchanges and what we do with some of the central banks as well, because that's clearly our core business in Africa, which is the information piece, which is clearly unlocking that and providing my panelists with that information to make their investment decisions. But then I also want to talk a little bit about what we do with some of our other pieces of our business in terms of actually improving the investment climate and the business operations. So, for example, in our legal information business and legal software business, we specifically are working with governments and in discussions with African governments and the judiciary there to improve transparency, to improve access to the rule of law, and we do that mainly through helping governments publish laws. I mean, we're working right now with Lagos State, specifically on publishing the laws of Lagos State. And that's just merely making laws available to corporations, investment firms that they may not have had access to before because it was stuck in a closet somewhere or wasn't published publicly. And so we're working with projects like that, but then we're also working with judiciary in terms of increasing transparency and decreasing the corruption that many of my panelists have talked about. We look at projects to publish court decisions, make them public in terms of who the judge was that was sitting on the bench, who the lawyers were that were in the courtroom arguing against that, and then basically doing the trend analysis on their decisions, so there's no more hiding, there's no more corruption in terms of being able to not see who made a decision based on what criteria. And that's really important to what we do in our core ethos in terms of our ethics and our values at Thomson Reuters. One of the other areas that we look at with one of our other businesses, in our tax and accounting business specifically, and we're doing a lot of work on the continent, is with land registry and transparency around land ownership. Specifically, we have projects going on in several states in Nigeria. We have projects going on with several counties in Uganda right now, working with several other West African countries right now. But that's core and fundamental to improving investment climate in terms of just, in terms of infrastructure projects. If who owns the land? How, if I have this piece of land, can I sell it? Can I put that road on it? Can I put that hospital on it, and not be worried that it's going to be taken away later? And that's core and fundamental, and we're helping digitize that, make it publicly available, make websites that show clearly who owns the land, and that there's not 6 land registries in the back room, and depending on when you walk in the middle of the day, figure out who owns the land. So that's core and fundamental to some of the things we're doing. And then, as Ed mentioned, I mean, one of the major impediments of doing business on the continent is tax and understanding your certainty of your tax position. I mean, when you make a $50 million investment, you want to make sure that you're getting a return and you're not paying. You have no certainty whatsoever about what your tax position is. And regulations and laws around tax are changing every day, and Thomson Reuters is definitely in the business of working with governments and corporations to make those legislations understandable and make them transparent in terms of when they're enacted, and make sure there's consistency around the enactment. We're specifically doing things around transfer pricing, working with governments all across East Africa at the moment in terms of helping them set up transfer pricing legislation and then giving them the comparables to ensure that it's transparent and corporations can understand their tax position as it relates to that. So as investment firms and as companies do business, they'll understand their tax position. And then, like I said, I mean, as I said before, the obvious impediment to investing in Africa is just simply access to trusted and reliable information and analysis tools to make those decisions. And I guess I hope it's obvious, but we have very powerful tools and global platforms that we bring to bear, and many of my panelists use our platforms every day in terms of doing that. But what we're doing specifically in Africa, I mean, Thomson Reuters reorganized about 18 months ago to focus specifically on growth geographies. And that's part of the reason my position even exists, to manage Africa from Africa as opposed to other places. And that's a key theme you hear throughout is you need to be on the ground in Africa. So just simply increasing our depth and breadth in Africa, both in human capital and in technology. So when I look at, not just bringing to bear our global technology and our global platforms and investing that into Africa, we're working with exchanges, we're working with central banks to create new products and services that are Africa-specific and address Africa-specific problems. And then we're also investing in communities. I think one of the other things is we're bringing investors together through online chat rooms, online platforms, and then having conferences around that with our Trading Africa program. So there's a lot that we're doing specifically to address a lot of the challenges that my fellow panelists have talked about. One of the things I picked up on as well in terms of what Ed said that I just kind of want to mention, I wasn't originally going to talk about it, but Ed mentioned due diligence, and I think Sarah mentioned just knowing who your customer is and looking them in the eye. There's absolutely no substitute for looking your investment in the eye and understanding their practices and if they're corrupt or not corrupt. But we also have many of you may be familiar with our World Check business. We have about 200 employees based in Cape Town that specifically do background checks for corporations and investment firms like this. And we have a unique capability to do the anti-terrorism, anti-money laundering checks, and just in general background checks around African companies and African investment opportunities. So there's a lot that we have going on, Sunil, and it's an exciting time to be part of Africa because the main piece is, I think Ed said it, when you're comfortable investing in Africa, you get it. Once you're there and you know it, you get it, and that's what we're trying to do, is helping people get comfortable with investing in Africa.
Thank you. Barbara has told me that we've got time for one question only from the. That's maybe two. Okay, so I'll take the liberty of opening because it seems that there are a number of hands in the public.
Hello, I'm Marie-France Mattes. I'm Managing Director with Emerging Capital Partners, ECP, and I have a number of comments. First of all, I would like Ed to correct something that you said early on, and you said you were the first US company investing in Africa.
I don't think that's what I said. I said the first major alternative investment manager, KKR,
okay.
Blackstone, etc.
So ECP was
I will
founded
not correct that.
13 years ago here in DC. We have at the moment 7 offices in Africa. We have over 27 professionals operating, the majority of them in these 7 offices. So we have raised over $2 billion in investments, and we have now put to work that money. And this is an area where we have been very active in growth equity investments.
Sorry, can you tell us what your question is, please?
So I just wanted to comment on the capital raising, and
Yes.
I think the capital raising is a very important aspect for Africa. There are all these aspects of information available and so forth. I just wanted to say that it is not an easy environment. We just had a very big success in a co-investment. We raised over 550 million in equity for one of our portfolio companies. So it is a very difficult environment. There is no question. It was just a comment on saying that this is an environment where you need a lot of feet on the ground.
Okay, thank you. Yes.
Hi, my name is Brianna Clark. I'm a lawyer and a member of the media, and there was a question raised on the perception of corruption versus the actuality of corruption. I think everybody skirted it. Mr. Matthias raised it. What is the corruption as pervasive and as much as we hear or don't hear in the media, or is it a perception that is biased by our Western United States media?
We could spend the hours on that. The first question might be, what's your definition of corruption? Things that we think are corruption. Yeah. I'd just say we're very conscious of it, but not just here. It's true in India, China, others. There's what I would call a lot of leakage in the system. And it's almost like I would say, don't ask, don't tell. You get as much information as you can, but you never know for sure. It's a lingering problem and something I think all investors are very conscious of, and the publicity basically accentuates it. I mean, my guess is it's not quite as bad as what people say, but it's a real factor.
Can I just add onto that? So one of the benefits of going in the private equity route is that you have a lot more insight and control over issues that might be perceived as corrupt. So while you can't necessarily change the country, you can make sure that you're not investing in corrupt companies, and you can make sure that there is no corruption while you're owning the company, right? And that is your fiduciary responsibility to your LPs. So I think that if we could change the dialogue around from is Africa corrupt, or certain countries or cities or what, to showing examples of non-corrupt companies, right? And that not everybody is corrupt. That's where I think we need to go.
Okay, a last comment?
I'd just like to make one final comment, and that is the need for capital markets. I mean, in Africa and in some of the developing countries, you need to have more breadth and depth in the markets. In some cases today, debt, which is not readily available, provides a higher return equity. So if you get good public markets, I think that will be a tremendous force for growth, and I think that's going to require government support to do it. Right now, the public markets, in my opinion, are fairly narrow. You have the telecommunications, some of the utilities, energy. But to broaden and deepen the markets would have a huge effect on Africa, and it would enable exits, it would enable companies to get financed, and it, in my opinion, should be a very, very high priority for those who have an influence.
I'd just like to jump on what you said, Ed, to sum up this discussion. I think, yes, you're right. We need broader and deeper public markets so as to grow Africa in the future. But I think private equity firms or investors, GPs and LPs, have a very important role in accompanying that change that you just mentioned, because I think there's a need to use more and more African exchanges for exits, bring up IPOs, because this is what is going to grow the market and make those markets more liquid and more attractive, and attract more investors into those markets. Other than that, other take-ups that I have just to highlight very quickly is I think we leave this discussion, I personally leave this discussion very optimistic about the future of Africa in terms of funding. Based on what everybody has said, it's very clear that we are privileged witnesses of what I call a gradual but yet irreversible shift in terms of international asset allocation in favor of African countries and African companies. What I also would like to highlight, based on what has been mentioned during this panel, is that there is a need for local investors to back up the foreign capital that is flowing into these markets. So we should see more and more local pension funds, local insurance companies, local institutions, local high net worth people bring their money and their contribution to the table so as to grow African capital markets and bring all those billions that are necessary to fund Africa's future growth. I also hear that access to information, but also certainty, especially on the taxation side, on the fiscal side, is very important, so that investors know where they're getting into and what they should expect in terms of treatment, fiscal treatment. So I think that's it. So I would like to thank our panelists for this very insightful discussion, and I would ask you to give them a big round of applause. Thank you, everybody.
Doing business in Africa. You can't afford to be without Africa Investor.